Hello and welcome to the broadcast. I'm DJ, the founder of Duransburg International, the Seven Spheres of Money system. Today's topic is how to build wealth, part 2, mutual funds, paper assets. So today I will share with you what a mutual fund is, what type of mutual funds there are, and how to maximize mutual funds as one of your plans to build wealth in your wealth strategy topic. Okay. So since everybody here on Periscope are making, thousands and thousands of dollars a month on Periscope, and they have all kind of digital products and services, it's awesome. So what we want to teach you is how to actually keep that wealth and maintain that wealth. Because if it comes in and you don't keep it, what value is it? Okay. How you doing today? Welcome to the broadcast. Welcome to the replay. Again, I'm DJ. I'm the founder of Duransburg International, the Seven Spheres of Money system. Have been an entrepreneur for 2 decades and have been successful in building 4 7-figure businesses in 2 decades, as well as have helped over 100 people become financially independent and actually have helped over 1,000 people become financially consumer debt free. So today's topic is part 2, how to build wealth strategies. And today's topic is specifically about mutual funds. Okay. So let me show you what the value of mutual funds can have for you in building your secure investment strategy. Okay. I'm not going to tell you how to make money on Periscope. I'm going to tell you how to keep the money that you make on Periscope, as well as share with you how to keep the money that you make in the bricks and mortar world and your regular job. Because it's one thing to make the money, but most importantly is to keep money. Okay. So let me just show you this on the screen here. All right. If you would like, take a screenshot. You can go to the website, the7spheresofmoney.com, and we'll give you a free complimentary How to Buy Insurance the Right Way PDF, along with the 7 Spheres of Money Periscope that breaks down every 7 spheres of money. So today we're going to talk specifically about mutual funds. What are they and how are they maximized in your portfolio on your route to wealth? How you doing today, Jay? Welcome to the broadcast and welcome to the replay. So if you want to take a screenshot of this, go right ahead. Excuse me. Got a little bit of nose itch today. No problem. Now, here's what I want to share with you about a mutual fund. And most people know what mutual funds are, but most people don't know how mutual funds actually work and how they benefit you. So a mutual fund can only maximize profit for you in 3 ways. It can maximize profit for you as a dividend. A dividend is what's called a distributed profit. And the company that provides the dividend gives the dividend really only for tax breaks. Not because they want to share the profit with you. It's because they get a tax incentive from the government to actually give dividends away. So dividends are the best way to actually generate residual income from stocks and mutual funds. That's the only way to get passive income is through dividends. So as you start to look at stocks, start to look at mutual funds, look for the ones that are going to give you dividends. The second way that a mutual fund can generate money for you is through capital gains. Obviously, that's real simple. All you have to do is take the actual stock that you bought. Let's say you bought a mutual fund at $20. And 2 years later, that mutual fund was worth $60. When you sell that mutual fund, you will realize a capital gains of $40 per share. And then the other way that you can guarantee to have wealth built through mutual funds is just through pure appreciation. And appreciation is just the value that it possesses on paper without you selling it. So again, if you had the mutual fund, you bought it at $20, 24 months later, that mutual fund stock went up to $60. It is now worth $60 to you per share, but it is a paper asset. Until you actualize it as selling it, it has no discernible value to you. It's just an appraised value. Okay. Now, most importantly, when and how do you use mutual funds? Mutual funds are 6 types of mutual funds. One is called a money market mutual fund. This is a mutual fund that actually you put your cash in that you want to have access to it immediately without any repercussions. Again, a money market mutual fund is where you lay cash for a short period of time that you can access it liquidly, just like having a bank account. Okay. So if you don't know what you want to do with your money and you have a lot of money or you have some spare money set aside, then put it in a money market mutual fund until you figure out the game plan of what you want to do with the money. A second type of mutual fund is called a bond. And a bond, all that is you are providing the government, municipality, the state, or the city with a debt structure, and actually they give you a fixed rate of return on the bond for them to build bridges, schools, things of that nature. The next type of mutual fund is called a balanced mutual fund. And a balanced mutual fund is a mixture of T-bills, money markets, and bonds. Okay, so it gives you a little bit of everything. And it basically enables you to hedge your mutual fund without getting the lows in the market, and you don't get the extreme highs in the market. So it gives you a level kill functionality. The next type of mutual fund is called it's called a large cap mutual fund. How you doing today, Gary? Welcome to the broadcast. A large cap mutual fund or a large cap stock is really what we call a blue chip mutual fund or a blue chip stock. And that is any stock that has a market capitalization of 25 billion or more. 25 billion or more. That'll be your IBMs, which will now be your Microsoft, which didn't used to be a large cap fund. That'll be your Best Buys. That'll be your Sears. These are what's called large cap mutual funds or large cap stocks. Remember, that's 25 billion or more in market capitalization, as well as the Walmarts of the world. Your next mutual fund is an international fund. That one actually has the most risk. That'll be like investing in the Nikkei, investing in Australia, investing in China. So these market international funds have lots of volatility. And then last but not least, out of the 6 types of mutual funds is a small cap. And a small cap is generally a new business, up and coming, a startup, just like Twitter is, just like Periscope is when it goes public, just like Netflix. These were all at one point in time small cap funds, and they had $25 billion or less of market capitalization. And market capitalization basically just means what is the perceived value of the stock to the actual shareholder. What is the perceived value of the stock to the shareholder? Now, one way to actually maximize mutual funds for the maximum profit and hedge is to actually use a strategy called asset allocation plus dollar cost averaging. Asset allocation is how you pick the mutual fund, how you pick the stock. Has nothing to do with timing, has nothing to do with term. It's actually how you pick it. So it's basically looking at the industry, looking at the type of stock, looking at the type of mutual fund, and making sure you've done all your homework. Once you put that together with asset allocation and then couple that with dollar cost averaging, you say, you know what? I only have $25 or $100 a month that I can actually invest. So I'm going to put this on automatic pilot, and this will actually purchase stock every month on certain period day, like the first. Every month you will invest $100 in purchasing mutual funds. So when the market is down, and actually the asset allocation model that you chose actually have the right mutual fund or the right stock in it, guess what? You will get stocks at discount prices. You'll get stocks at discount prices. And I'll give you a great example of what I mean by this. So, sorry about that. So remember in 2008 when the market crashed, most of the major blue chip stocks were in the trash. Ford was down to almost 88 cents a share. And at a record high where Ford was up to like $80 a share. If you had dollar cost averaging and you had asset allocation, you would actually been able to purchase that stock at a tremendous discount, because now Ford stock is back up to something I think like $40 a share. Or give you another example. When oil all of a sudden, tanked and it went down to $40 a share, then it rose up to $100 a share. If you had dollar cost averaging along with asset allocation, you would have bought these stocks at tremendous lows, and then when the market started to come back, you would have gained 4-10 times the value of them because you had this set on autopilot. So this is one of the ways to actually build wealth, but a lot of people don't find this stuff to be sexy. But as I said again, I'm not here to teach you how to make money on Periscope. I'm here to teach you how to keep that money that you make on Periscope. And the only way you can keep money is to have money make money for you. And money is only here to make more money. And there's only 3 ways to have money make money for you. You can make it through paper assets. That's mutual funds and stocks, bonds, annuities. You can make it through real estate. That's in a passive stream of actually doing rental properties where you have passive income coming in, or you can flip it, or you can actually acquire commercial properties or commercial real estate. And then the third way, which is the most riskiest but the biggest reward, is actually to actually start a business or actually invest in a business. So those are the three ways that you can actually make money. There's no other way to do that. But in order to get there, you have to have three plans. You have to have a security plan, a rich plan, and a wealthy plan. And before you go out and risk everything that you have, you should always have a security plan, and you should never risk your family house and your family assets that you have worked hard to get to where you are right now today. And that's one of the things that a lot of people on these periscopes are not speaking to you about, because they're just trying to tell you, hey, you know what? You can make money hand over fist. It's easy. Look what I did. And you know what? That's great. I'm not knocking that. I'm all for capitalism. I'm all for people succeeding. But what I'm not for is when people are not telling you the actual truth of how wealth is obtained, and most importantly, how wealth is secured and preserved. So in order for you to actually successfully jump your way out of corporate America or self-employment into actually true wealth and actually sustain itself for decades to come, you have to have a plan. And this is the road that you will take. This is the road that most wealthy people take. Wealthy people invest in stocks. Wealthy people invest in mutual funds. Wealthy people invest in real estate, and wealthy people invest in businesses. And all of those investments have their nature of risk and reward. They have their nature of risk and reward. You have to find out what's your risk quotient in order to gain the reward. And most importantly, you have to make sure that you can actually acquire financial intelligence along the way and increase your financial IQ. Because without a high level financial IQ, if you made a lot of money and you don't know how to keep it, you're actually going to be worse off than what you were. That's why statistically, 85% of lottery winners are actually dead broke 3 to 5 years after they've won millions of dollars, because they had a zero financial intelligence quotient. They had a zero financial intelligence quotient. But if you have a high financial intelligence quotient, you can literally take as little as $1,000 and turn it into 1 million over a course of 20 years if you knew what you were doing. So again, let's recap. Today is the second phase of part 2. It's the mutual fund. It's not sexy, but this is one way for you to achieve financial wealth long term after you made all your millions and 6 figures and 7 figures on Periscope. A mutual fund only can make you money 3 ways: through dividends, which is distributed profits from the corporation and actually gives you a passive stream of income. Number 2, capital gains. All that basically is, if you bought the mutual fund at $20 today, and then tomorrow the mutual fund went up to $40, you sold it, you exercise it, you get a capital gain of $20. And then appreciation. You had it at $20 today, tomorrow is worth $40, but you didn't sell it, so just on paper, it appreciated. There's 6 types of mutual funds. Money market mutual fund is a mutual fund that actually you park your money as cash and it's liquid, but you don't know what you want to do with it, and there's no penalties to take it in and out, okay? A bond is real simple. That's basically a bond mutual fund that has mutual funds that are centered around municipality debt, centered around state debt, centered around government debt. They give you a fixed rate of return. Thus, they call it a bond, which is a debt equity vehicle. Next thing is a balance mutual fund. A balanced mutual fund gives you a little bit of everything. So it gives you the middle tier of the market, which I call mediocrity, but it doesn't lose you anything. So that would incorporate T-bills, money market, bonds, things of that nature. The next bond is what they call a large cap bond, or what we call a blue chip stock. And that is a bond or a mutual fund or a stock that has a market capitalization of 25 billion plus. Okay. The next one after that is called an international international mutual fund. That one has the highest risk, because these are things like the Nikkei, investing in China, investing in Australia, investing in Africa. We can't really determine the highs and lows, the ebb and flows of their markets. And since we can't do that, that's a high risk, but at the same time, it has a high reward. And then last but not least, it's what they call small cap. That's any business that has a market capitalization of 25 billion or less, generally a very new business or a startup that's generally 5 to 10 years old, and that business is actually a engaging technology that people are starting to invest in, just like Periscope. That is a game-changing technology, thus it's going to be a small cap if it were actually a fund available. And then how do you maximize penetration of leverage with mutual funds? You maximize them real simple by taking what's called dollar cost averaging, couple that with asset allocation. Asset allocation is what I pick the mutual fund, the right pick, the right stock, the right industry. And then take dollar cost averaging, which is basically taking, say, I have $25 I can invest a month, or I have $100 I can invest a month, or $1,000. And every month on the first, this mutual fund is on automatic pilot with asset allocation, and it is actually buying mutual funds at the lows of the market and actually giving you the highs of the market. But it is working together to give you a great recipe. So this is how to actually look at mutual funds from near and from far. So if you don't know how mutual funds work, and if you did know how mutual funds work, what you should do is go back and look at your mutual funds in your investments. And here's one bonus tip. Here's one bonus tip for you. There's also a thing called automatic rebalancing. You should put your mutual funds on automatic rebalancing so that it rebalances twice a year automatically. And what this enables you to do, if you have a variety of the 6 different mutual funds in your portfolio, if one of them has more of a risk than what you really want to actually have more of, automatic balancing will actually even things out for you. If you do what's called a risk asset evaluation. So what you do in a risk tolerance asset allocation evaluation is that you actually choose percentages of what these mutual funds you would like to invest in. So out of those 6 mutual funds, for instance, with international, you would say, you know what, I only want to have 5% of my money invested in international. So if the international market actually goes exceedingly high and it's on a run, on a bull run, it'll probably exceed the 5% of your portfolio. But what automatic reaccount balancing does is actually brings it back down and spreads the wealth over the other mutual funds that you have in your portfolio. So this way, if that market tanks, it only takes down 5% of your mutual fund value, okay? And a lot of people will tell you, you know what, you can't get wealthy with mutual funds. But you know what? We're not here to strive wealth on this model. We're actually here to subscribe to security and actually help you create riches by actually having one other strategy of investing. And I'll talk further on my next couple of Periscopes. We're going to cover a lot more details about more sophisticated investments. But in order to be financially intelligent, you have to start with the fundamentals of investing. And that's the reason why we're going to take it step by step by step. We're going to crawl, walk, run you to success and wealth. And that way we'll make your money make you more money. And you'll better come with us on the Pom Pom lifestyle, which have plenty of money and peace of mind. And you better join the Beaches of the World Club. Again, I'm DJ. I'm the founder of Duransburg International and the creator of the 7 Spheres of Money system. I hope that this was of value to you. And if you want any more value, all you have to do is go to 7spheresofmoney.com. We're giving away a free PDF. We're giving away a free PDF of how to buy insurance right. And this covers any type of insurance that you can think of. And we will show you exactly how to buy it, when to buy it, how to leverage it. And in conjunction with that, we will break down the 7 Spheres of Money system from accounting to financial planning and how to utilize it as you walk through life to become secured, to rich, to wealth. So I thank you for coming out. Have a nice day and God bless.